In my conversations with insiders about the way I plan to invest in some opportunities, and even in the email I sent everyone last week about how I planned to play a specific stock, I mentioned 3 options strategies that I would use or might use to improve my returns long term. After that, I had a flood of requests for additional information and context, specifically how these strategies work and when it makes sense to use them. So that's going to be our theme for this week. If you're interested in adding some additional investment tools to your strategy arsenal, then you're going to want to stick around. Hey there, my name is Steven Spicer, and it's my goal to help you invest smarter. And by mastering even these 3 basic options strategies, you'll be able to do just that. You'll be equipped to increase your returns without any additional research beyond what you're already doing. You can take that research that you should be doing and actually profit from your existing thoughts on a particular stock. You'll see what I mean. So in this video, I'm going to dive into using covered call options. And then in the next 2 videos, I'll explain and explore how and when you might want to use long-term equity anticipation securities, and then the benefits of selling cash-secured put options. So if you're interested in learning these strategies that could help you invest smarter, hit subscribe and the notification bell so that you don't miss a thing. When you understand covered call options, you'll be able to take the analysis you already have, identify the price at which you plan to sell out of it anyway on its way up, whether because that would mean the stock is now over or even just fairly priced, and so you'd be selling out anyway in order to take advantage of some other better opportunity. So with this, you can take that information, that plan, and profit from it today, regardless of what the stock actually ends up doing. By the end of this video, you're going to understand exactly how this beautiful strategy works and when it might make sense for you to use. Now remember, I'm speaking to a lot of people here, so I understand that many of you will be at different levels of understanding when it comes to options in general. So please, if some of this is too basic for you, use the detailed timestamps in the description to hop around and get to the parts that will help you the most. That's the reason I spend so much time on those for every video. So let's get started with the basics. An option is a contract that allows its owner to control, buy or sell, a separate asset at a fixed price called the strike price or exercise price for a specific period of time. And they don't just exist in the stock market. I've even used them with my real estate before. Say, for example, you go to sell a rental house that you own, and the current tenant reaches out saying they're interested in purchasing your house. For whatever reason, they can't qualify for financing now, but they like the ability to buy it from you at some point within the next few months. Well, I want to sell it, but I have no guarantee that it would actually sell over those next few months anyway. But if I take it off the market just for the chance that my tenants are able to secure funding in that time, if I do that, I'm taking a ton of potential buyers off the table just in favor of this one potential buyer. That doesn't sound like a great deal to me, unless they pay me for it. So to make my waiting worth it and to compensate me for the risk that the tenant is ultimately unable to purchase anyway, they pay me $500 for the option to purchase this home for $50,000 at any point within the next 3 months. There you have the basics of an option contract. If they end up getting the money and exercising their option by purchasing the house from me, great. It might have been on the market for this long or longer anyway, so obviously it was worth it to me. And having the exclusive right for them to purchase this house so that nobody else was able to was obviously worth it to them, so it was a win-win. If they don't get the money, or for whatever reason just don't end up buying this particular house within that allotted time period, well, either they pay me another $500 to extend their exclusive right for another quarter, for example, or I put it back on the market. I may have lost some opportunities over those 3 months, and the value of the house may have changed a bit, but that $500 that I made by selling my tenant the option contract was pure profit. There are, of course, other considerations, but hopefully you get the general idea. This may happen to you at some point in the future. You're trying to sell your car. Somebody approaches you who really wants it, but needs a month to pull together enough money to buy it. You could just say, sorry, tough luck. Or you could make them pay you for the option. You'll take it off the market for a month, and during that time, they'll be the only ones that can buy your car from you. Or maybe you're on the other side of the deal. You're the one who really wants the car, but you just need a little more time to get the cash. You approach the seller and offer to pay them $100 outright for that exclusive option. So even if you don't see them all the time, hopefully you can understand why option contracts exist. But although they absolutely do exist in other places, nowhere is there quite as vast a tradable market for them as you'll find in financial markets. Specifically, we'll be looking at options derived from the stock market. A stock option contract is quoted like this. Clearly, there are many more variables with options than when you're just dealing with buying or selling shares of a stock. It's important that you understand what you're looking at here and some of the more important terms associated with trading options. The first letters tell you upon what stock this option is based. The stock is represented here by its ticker symbol, the 1, 2, 3, or 4 letter code assigned to that particular company. Usually, one quote, one contract like this represents control over 100 shares of that underlying stock. Next, you see the date that the option expires. This is the last day that you could trade this option. They usually expire on the third Friday of a given month. The next number you see is what's called the strike price for the stock. It's the price that the stock, if the option is exercised, will change hands, regardless of the underlying price at the time. So in this example, this option gives its owner the right to exchange each share for $50, whether the underlying stock price is $70 or $30 or whatever. Then the quote tells you which kind of option you're dealing with here. At the most basic level, there are only two different kinds of options, calls and puts. Throughout this series, we'll explore both of those. In this video specifically, we'll be going through a specific call option strategy. In brief, a call option gives its owner the right, but not the obligation, to buy stock at a specified price within a specified time period. A put option gives its owner the right, but not the obligation, to sell stock at a specified price within a specific time period. And finally, rounding out this quote, you see the premium, or cost per share of the option. You'll recall that option contracts usually represent 100 shares of the underlying stock. This quoted price that you see is per share. So usually to figure out how much you'd need to pay in order to own this contract, you have to multiply this price by those shares. So $1.10 per share times 100 shares equals $110. To own this contract, this right to a specific stock, you'd have to pay $110 plus whatever commissions your broker charges you. Using option contracts allows you to pay a relatively small amount of money to control assets worth much, much more. It's a form of leverage, using a small tool to control and potentially profit from much larger assets. Let's explore the power behind this concept briefly. If you were bullish on a stock, the made-up XYZ company in this example, expecting it to go up in the future, and its current price is $45, you could just buy 100 shares for $4,500. Or you could essentially control 100 XYZ shares by purchasing that contract that we just looked at. All you have to do is pay $110, and now you have the right, but not the obligation, to buy it for $50 per share before March 15th in this case. So let's say you do that. You own this contract now. Let's look at some extreme possible outcomes to fully explore the implications here. Your risk, your exposure to this stock is now limited, meaning if the stock actually goes down over this period, you're only out that $110 you paid for the option. If it drops to less than $43.90, you would have been down more than that $110 anyway, had you just owned the stock outright. And just to hit the extremes of this example to prove the point, If the stock price tanked over that time or the company goes bankrupt, again, you're only out that $110, no more. If you had actually held the stock, you would have lost much, much more. On the other hand, what if the underlying stock goes up? Well, because the strike price of the option you own is $50, any move above that price, which for a call option is considered to be in the money, would justify you exercising that contract. If it moved up to $51, for example, you could buy those 100 shares for $50 each, or $5,000 total, and then immediately sell them for the market price of $51 each, or $5,100 if you wanted to. Did you make a profit there? No, you'd still be out $10. The $5,100 that you just made minus the $5,000 that you paid left you with $100. But you can't forget the original $110 that you paid for the option to begin with. So, to be profitable would require the stock to move above $51.10, the strike price plus the premium paid. But then, because you're using leverage here, every move higher would represent a significant potential return. For example, if the underlying stock moved up to $55, you could instantly make $500 by exercising the contract at $50 per share, paying that $5,000 for your 100 shares and immediately selling those shares for $5,500. Factor out the $110 investment you made in this option to begin with, you realized a profit of $390 on a $110 investment. That's not bad. That's actually pretty solid. A more than 350% return on investment. And on an annual basis, it's far more than that when you consider that it was done over a month's time, as I record this in February. Just for fun and to demonstrate the power of leverage here, let's make it go up another $10. On March 15th, the stock price of that underlying stock just hit $65. You exercise this option and immediately sell those shares. After subtracting out your initial investment in the contract, you profited $1,390, or more than 1,250% return in a single month. So you can see the power this leverage could give you. You know exactly how much you have on the line if things go wrong, and you have the potential to profit significantly if things go as you expect. Now remember, even that $10 move from $45 to $55 was a more than 20% jump for the underlying stock over that month. Absolutely possible, but that's not going to happen that often for you. More often than not, options expire worthless, and therein lies a big risk for casual investors. There's a temptation to see that potential and buy option contracts that represent far more shares than you were initially even considering with the underlying stock. For example, you had $5,000 to spend on that aforementioned stock deal. You decided to use the power and leverage of options to play your thesis instead of stocks. You could just spend that $110 to control those 100 shares that you're interested in, but think about how much you could control with all of that $5,000. That could buy you like 45 of those contracts instead of just one. Maybe you drool over that 350% return we just talked about being realized for your entire $5,000 instead of just a measly $110. That would be it growing from $5,000 to more than $17,000 in just a month. Yeah, that's tempting. But you have to remember that most options expire worthless, which means a 100% loss on whatever you paid for those contracts. If you spend all $5,000 on options, that would be irresponsible. You're risking everything. If you spend $110 on the option to control $5,000 worth of stock, you're putting 2.2% of the funds you have allotted for this particular position at risk, which may or may not be a prudent move for you, but not near as irresponsible as the one I just described. Options can be a valuable tool, but when you see their power, the temptation is absolutely there to use them to speculate, or worse, to gamble. And that's extremely dangerous. That's the reason that Warren Buffett publicly criticizes derivatives as financial instruments of mass destruction. An option contract is a derivative. Its value is derived from the underlying stock. Like a bomb, you must use caution when around them. And please, don't take this series of videos as me telling you to use them. I'm not. They have the power to blow up someone's entire portfolio if you're not careful. But I'm not naive. I know you're exposed to them, at least conceptually. You hear about people using them, so obviously the temptation to use them yourself will be there. And I don't want to just discourage it, because I use them. Heck, Buffett uses them, and we'll talk more about that in a later video. But I do want to make sure that you're careful, and I'd like to help however I can. If you're planning to get into options anyway, and only after you've done a ton of research and really understand them and all the implications that come with owning or selling them, I'd recommend starting with one of the 3 strategies I mentioned earlier in this video. And that's why I'm going to walk you through each of them. Now, there's one more aspect of options trading that you'll need to understand before the idea of covered calls, that first strategy that we're going to explore, can make sense. Here it is. When you bought that option contract from earlier for $110, where did it come from? Someone had to sell it to you. That could be the market maker, it could be your broker, or it could just be another individual trader interested in taking the other side of that bet. Remember, most of the time option contracts expire worthless, meaning the one who made the purchase lost 100% of the premium, which would also mean that the person who sold the contract made $110 on that deal, minus commissions, of course. That sounds great, right? Being on that side of an option contract like this is called selling or writing a call option. You are essentially paid that $110 so the buyer has the right to buy 100 shares at $50 per share from you. But that means that you now have the obligation to sell those shares at $50 should they choose to exercise that right. If you don't own any shares of XYZ already, but choose to sell a call option, also called a short or naked or uncovered call, your potential loss, in theory, is unlimited. If the price of the underlying stock just keeps going up, as long as you own that short call, you'll just keep losing more and more money. With our example from earlier, if the stock price were to soar to $65 per share, of course, the owner will exercise his or her option to buy those shares at $50. That means you have to sell them 100 shares for $5,000, 100 shares that you do not have. So to get them, you will have to buy them in the open market for roughly $6,500 for an immediate loss to you of $1,500. Well, minus the premium they paid you of $110, so a net loss of $1,390. If the stock price had gone up by $5 more before expiration, you would have lost another $500 just like that. And sure, it's unlikely that the stock would double in price over that month, but it's not impossible. If that happened, you'd be out almost $4,000. You get the point. All that risk just for the chance to make the relatively small profit of $110. For traders who are interested in dipping their toes into the world of options, I'd recommend selling calls only when you already have the shares on hand to satisfy any potential execution of your contract. In other words, you already own 100 shares of XYZ, and then you sell a single call option contract. This is called writing or selling covered calls. Let me give you a quick example of when I might use this strategy. Now, I rarely purchase shares in a stock unless I expect significant upside potential, at least within the next couple of years. So I'm not using this strategy right out of the gate. There are some others that I might use right from the beginning, and I'll cover those in the next couple of videos. So subscribe, because obviously this stuff is going to help you invest smarter. So why wouldn't I use covered calls right from day one? Well, if I'm expecting high upside potential, writing those calls would cap my potential gains while still being exposed to the downside that comes with owning actual shares. With the example from earlier, I buy 100 shares at $45 for $4,500. Let's say I immediately turn around and write that call option from earlier. You pay me $110. Great. If they expire worthless, which as we know they likely will, I just made over 2% and I still own the stock. Pretty cool, right? But if my thesis plays out, perhaps quicker than expected, and the stock price jumps up to $65 per share, for example, if I had just owned the stock, I'd be up more than 40% on that position. But because I had sold that call option to you, of course, you're going to exercise it. You're going to buy those shares from me for $5,000, and now I've only made $610 on the deal. And I'm no longer in the stock that I had researched and I liked and I expected good things from over the long run. That's not the end of the world, I know. That was a quick 13% return on my position. But like I said, I'm only entering a position if I see a reasonable possibility for 50 to 100% upside over the next year. I know all my positions won't do that. I just need one or two of them to do that each year for me to hit my personal investment goals. But if I'm capping all of my positions to a 10 to 15% gain, and still exposed to the downside, just so that I can make that 2% return from all their premiums, that may not be a terrible strategy for some, but for me, I'm shooting myself in the foot. It won't work with my holistic strategy. And I hope that makes sense. Regardless, obviously this strategy is at least not as dangerous as any of the others that we've talked about so far. That's why I'd recommend this one, or perhaps one of the next few that we'll cover, before trying to get any more creative, which I don't recommend anyway. But let me tell you now how I personally incorporate this strategy into my trading and why I like it so much. What if, when I entered XYZ at $45, my thesis that came from my detailed analysis suggested a fair value of $90 per share? If after a while, it doesn't really matter how long, the stock price is approaching that number, let's say it's $80 after a year, that's when these can really come in handy. Now, as people who have been through my value investing course know, if some fundamentals have changed and my thesis has weakened, I'd likely be most comfortable just selling my shares at this point, locking in my 75% gain. Or if that fair value price for XYZ was still, even after that year, at $90, meaning the percentage upside was now way less than at first, and I felt pretty confident about some other opportunities that I was finding as having 50 to 100% upside potential, again, the best move for me would likely be to just sell those XYZ shares. But if the fundamentals and consequently my thesis are still strong, if I'm not really seeing better opportunities out there, and if perhaps that fair value price has been creeping or might creep up a bit, then this strategy is perfect. Listen up. Have you ever been in that position where your trade has gone your way? You feel like it's starting to peak, or maybe the stock is getting close to being overvalued, but you just really don't want to sell it quite yet. You think she has a little more to go. You know, you have a price in mind when you would like to sell it. That happens. A lot of people in this situation will put stop losses below their current price just in case the price starts to fall and just hang on to their position, their stock position. I think that's smart. But if you're not going to sell it because you'd like to see it go up just a little more before you do, you might as well profit from that mindset. If XYZ is at 80, maybe you put a stop loss in to sell your 100 shares and lock in your gain at $72, just in case. But if your research and analysis suggests that it has more upside potential, and you've told yourself that once it hits, say, $90, that's when you'll sell. You can profit from that mindset today while it's still hovering around $80. Why not write a call option with that $90 strike price? Write them 30 to 45 days out when the time decay is really starting to work for you. That's the time period when most options lose most of their value at an increasing rate, which is good for the seller of the option. By doing that, you could pull in an extra % or 2 in profit every month as long as your stock hovers around that price. If the stock unexpectedly crashes, well, hopefully the stop loss we talked about earlier will catch it, locking in your 60% gain. If it spikes up, you might be forced to sell your shares for $90, giving you a 100% gain. But every month that it just trades sideways within that $72 to $90 range, you're making passive income. Essentially, you're lowering your cost basis in this overarching play on this particular position, XYZ in this case. For simplicity's sake, let's say you're able to sell a single call option covered by your 100 shares for a post-commission profit of $100 every month. Now for your final calculation, once you do exit this position, you're lowering your cost basis. In other words, the net amount you have invested into each share. So you started with $45 invested into each share, right? Now each month that these contracts expire worthless, you're pocketing that $100 in premiums and essentially lowering your cost basis by $1 per share. So if after 10 months, one of those two scenarios finally plays out, the stock falls or surges, pushing you out of your underlying shares, your new cost basis after those 10 months for purposes of your ROI, return on investment calculation, would be, in this simplistic example, $35. $10 less than your initial $45 investment. So now an exit at $72 would represent a gain of 105% on that initial position. And an exit at $90 would represent a gain of almost 160% for your money. Remember, if you hadn't used the options there and had just used that stop loss and then discipline on the upside to sell immediately at $90, you would have only realized a 60 to 100% return, and you still would have waited those 10 months. But because of this simple strategy, you were able to realize the much greater return of 105 to 160% for that overarching position, XYZ. Wow, that was a lot. I hope it wasn't too much. I hope I got your wheels turning. You can see the power of these strategies and the benefit of learning and mastering these concepts. If you like more strategy videos like this one, please take a second to let me know by hitting the like button and just telling me in the comments. And don't forget to subscribe, at the very least, so that you don't miss the next videos in this series. I look forward to getting to know you better and helping however I can.